Right, welcome back to this series on learning how to trade. And if you've missed the first 2 episodes of this particular series, you can go back. I'll put the link in this video and in the description so you can start there, because you're going to get this really great workbook, this resource that then becomes your Bible of trading. So go and check that out. Today we're going to be going into the intermediate side of things. We're going to be talking about pips and points, position sizing, risk management, strategy stuff, orders, execution, and trade management. So this is a really important lesson. So find somewhere where you're going to be able to watch this video in quiet with no distractions. Save the video so you can watch it later. And if you've got YouTube Premium, I recommend downloading the videos so that you can watch them on flights and places where you don't have Wi-Fi. It's always great when you get into no distraction zones and you can really knuckle down and learn this stuff. You really take the information in better. Let's get stuck into this anyway. So pips and points, what are they? We're looking at Forex, but if you use the stock market, for example, you'll refer to them as points. But we're really talking about pips because this is about Forex trading, and pips stands for percentage in point. And what that is, so when you look at a currency pair, in most pairs, what you'll see is something like this. So you'll see the GBP USD, and you'll see that it's, I don't know, 1.2500. Okay, and that's the price, and it's the price of one currency against the other. The pound is what we call the base currency, because that's the first currency in the pair, and the second pair is called the terms currency. Okay, and what it means is if you was to buy the pound dollar, you would be getting 1.25 dollars to the pound. All right, and that's what that means. So if it goes up, if this goes up 10 pips, then the price would be 1.2510. So the pip is that fourth decimal point. So the fourth decimal point would be 1 pip. The second decimal point would be tens of pips. The third decimal point would be hundreds of pips, and then obviously thousands of pips on the left. So that's how it works, and that's what a pip is. So a pip, right? A pip is 0.0001. That's 1 pip. Okay. Now, for yen pairs, it's slightly different. So yen, JP, any pair with the yen in it, which is symboled JPY in currency pairs, it's 0.01. So it's just 2 decimal points. The same thing applies, but it's just 2 decimal points instead of 4. Okay, and it's going to be important if you're trading those any pair with a yen in it, obviously. But here's the key, right? A pip value changes depending on your position size. So a pip isn't always the same value, right? And I'm going to explain position size. 10 pips on, so if we go from 25 to 25.10, that's 10 pip move. Well, 10 pips on a micro lot, right, isn't the same as 10 pips on a standard lot. And don't worry if you don't understand micro lot and mini lot and standard lot. I'm going to explain that now, right? But you need to know that it's important, and the reason it's important is because if you don't understand that and what you're doing, your position sizing, you can lose control pretty quickly, especially as a new trader. And you need to know how much money you're risking, right, in terms of what those pips are worth in real money, right? So we want to talk about position sizing. Now, position sizing, let's talk about that. So if I was to summarize position sizing, it's basically the amount of currency units that you can buy or sell in a particular trade, right? Now, more importantly, position sizing allows you to control your risk. And we're going to talk about money management later on. We're going to talk about risk management in this video as well. But that's what it does, right? A good trader doesn't ask, how much can I make? A good trader asks, how much can I afford to lose and still stay in the game? There's a saying in poker, you lose all your chips, you lose your seat at the table, right? And you have to understand correct position sizing in order to be a really good risk manager and money manager. So let's talk about how to calculate, right? Calculating position size. So first of all, I'll give you the formula, and the formula looks like this. Position size equals money risk. Okay, so the monetary risk divided by the pip value multiplied by the stop loss, right? Now, I know that looks painful, but it's much easier to understand once I give you an example. So let's talk about an example here. So most traders, especially new traders, they tend to risk 1 to 2% of their trading account on any one trade. Okay, so if you've got a £5,000 account, right, times 0.02, which is 2%, that's going to be £100 money risk. That's how much of your capital that you've decided that you want to risk on one trade. Now, here's where the formula comes in, because now you look at where your stop loss wants to be, and I'm going to cover this when I talk about strategy in a moment, but let's just say your stop loss is 25 pips away from your entry. Okay, so let's just say you're buying and you're getting in, and your stop loss is going to be 25 pips below where you enter the trade, meaning that if the trade drops, if the pair drops more than 25 pips below where you entered, you'll be stopped out of the trade at a loss. Okay, so let's just say stop loss is 25 pips. This is all an example, by the way. Now, before I give you the formula on this example, I just want to explain a bit about mini lots and micro lots. So if you're trading a standard pair, the pip value is approximately 0.1 per pip per 1,000 units. That's what we call a micro lot. Okay, £1 per pip per 10,000 units. That's what we call a mini lot. And £10 per pip per 100,000 units is what we call a standard lot. Okay, now I want to stop at this point and say, I get a few comments on these videos saying, well, that, there's nothing, it's too complicated. You're overcomplicating it. If you find this complicated, that's because trading is, right? And if you're going to learn trading, it's not something you can just pick up and just run with after a day of learning it. This is a skill that requires you to be disciplined, to learn, to put in the education, to put in the hours, and you're not going to learn it just from watching this video once, okay? You really do have to embody what you're trying to do. You need to live it and breathe it, right? So for all those people in the comments saying, oh, there's nothing like overcomplicating it or keep it simple, well, trading isn't simple, I'm sorry. It's not a simple thing. And if anyone's told you it is, well, good luck. It's really not. They're selling you a dream, I'm afraid. So if you do the formula here, you can see with a £100 risk, because we've said we want a £100 risk of our, total £100 risk on the account in money risk, and we've got a 25 pip stop loss, right? We can afford a £4 per pip trade, right? That means we trade 0.4 lots, which is 4 mini lots. So what position sizing does is it adjusts your exposure so that your risk stays consistent, and it doesn't matter what the setup is, your risk will stay consistent. That's the point of understanding correct position sizing. All right, so let's talk about risk management then, because risk management is the art of staying in the game. Okay, as I said, you lose your chips, you can't play in the table anymore, right? So it's about preserving capital so that when your edge plays out over a long period of time, you're still around to benefit. And if you haven't seen my video on becoming an excellent risk manager as a trader, definitely go and check that out. It's been wildly popular, that video. In fact, I think that's the most important video you could ever watch on trading. So go and check that out. I'll leave it in the description as well. So what is proper risk management? Well, write this down, right? Know your risk per trade. And you want to know that in percentage and in real money. The next thing is you want to set a realistic stop loss based on structure and not your emotions. You get a lot of traders who just have these mental stop losses where they go, oh yeah, I know where I'm getting out, or they think they know what the market's going to do. You don't know what the market's going to do. Okay, you want to have a very consistent and objective way of placing stop loss, and things that you can use that do that are things like ATR, so average true range. That means you place your stop loss an average true range above the high of that candle or the high of that test. Other ways that you can do it is you might have a fixed position stop, like a 10 pip or a 20 pip, depending on the time frame. So on the 60 minute, you might just use a 10 pip. On the 4 hour, you might use a 20 pip, right? And so on. So it's just, you need a consistent way to objectively be consistent, basically, right? So ATR, fixed pip, etc. right? The next thing is keep your risk consistent, okay? And what I mean by that is no over leveraging because the trade feels right, okay? So you want to, no over leveraging because the trade feels right? You don't want to be doing that. And finally on this, I highly recommend you use a risk reward profile of at least a 2-to-1, meaning that every time you stand to lose 10 pips, you stand to make 20. Okay, basically your reward, your target order should be double the size of your stop loss. And what that stops you doing is relying on a very high win rate, because as a trader, your win rate is going to be around 50 to 65% ish. Okay, and I can say that confidently because I've worked with thousands of traders and I've met hundreds of very successful traders, and it always seems to be in that kind of sweet spot. All right, let's talk about the strategy. So rules of engagement. Now, the rules of engagement are going to be the things that you need in order to take the trade. Okay, so they're going to be a checklist. They're going to be a checklist that you work through where you go, okay, I'm looking for a setup. What do I need? What ducks do I need in a row in order for me to take this setup? Okay, now that might be a time of day. Okay, so it might be a certain time of day. You might go between 8 a.m. and 2 p.m. is when I'm allowed to trade. Okay, so that's the first thing I look at. So is it between 8 a.m. or 2 p.m.? It might be between 9 p.m. and 10 p.m. before you go to bed, right? It might be between the London Open and the New York Open. It might be just the London Open, 7:30 a.m. till 8:30 a.m. And that is the time window, right? Window where you're looking for those setups, okay? Another rule of engagement is you might need a bearish or bullish trend, a bias, okay? So a bias. What is the bias? You look at the higher time frame, and you say, okay, well, I'm bullish, okay? Tick, I'm looking for bullish setups. So you might need a higher time frame confirmation that we are in a bullish prevailing trend. Other rules of engagement might be mental. You might sense check yourself and say, how fearful am I on a scale of 1 to 10 of being out of the market today? Or how greedy on a scale of 1 to 10 am I for keen to be in the market today? And you score yourself, right? And only when you score a 5 or a 6 are you poised and mentally balanced. And then you need that as a rule of engagement to approach the markets. This is something not many people talk about, but it's a great habit to get into the thing of doing, right? So if you say, I need to be mentally poised, okay? Neutral. You need to be neutral. And only when you've got a neutral mentality and emotion, you can then proceed with your rules of engagement. Another rule of engagement might be no news, no major news releases, okay? So in other words, a rule of engagement needs, like, I can't have FOMC or ECB press conferences or non-farm payroll coming out within the next hour. I only trade when those news events are not taking place. And that's a rule of engagement. And then there's other like emergency rules of engagements, like solid broadband. The last thing you want to do is be trading when you've got intermittent issues with your broadband or solid power. You might, if you've got people doing roadworks outside your house and there's kind of or a power cuts going on, right? You don't want to be getting into trades in those situations as well. So you want to kind of think of as many things that are going to keep you as consistent as possible, including your emotions, external forces, and physical things and market conditions that allow you to be really, really consistent. Okay, so there's the rules of engagement. Now, once we've got through all those, it's now, okay, what other rules of engagement might we get closer to actually entering the trade? Well, if you're looking for a trend continuation, you could say, are we in a run or are we in a pullback? And only when we're in a pullback am I looking to go to the next step. So you're in the run, now we're in the pullback, and we want to get in somewhere in that pullback. Okay. Now, is there deceleration in price as we get into that pullback? Are we decelerating, looking like we're going to continue to the upside? Is there support and resistance? Right? Is there indicators that I can use, such as exponential moving averages? Right? You might use RSI, you might use MACD. Okay, we'll go into these a little bit later on in this series. So are there indicators that you could use? Look at my spelling, absolutely awful. Right, now if you've got a tick for all these things, okay, you might go to the next phase, which is the setup signal. Now this is basically going to be some kind of candlestick pattern, okay, or it's going to be a area that it's going to be a price point. So at this point, it's going to be that the actual setup signal is going to be a candlestick pattern that allows you to go, right, if this candle closes at a certain position or in a certain form, then I can enter the trade. Okay, so this might be a high test, which is very popular. It might be a low test, right? It might be a doji, which stands for indecision, right? It might be tweezer tops or tweezer bottoms. Right, if you haven't seen my video on trading for dummies, trading for beginners, you can go and watch that. I cover all of this off and give you a check sheet as well that you can tick off, print out, tick off as you're looking through the trades, the markets with me. So go and grab that if you haven't already. Or you might use something called an engulfing candle, which can be really, really popular and powerful too if used at the right locations in the market. So execution, now it's really about having objective rules into that execution, right? So once the signal is set and all of the pre-market stuff, the rules of engagement are met, and then you've got the setup signal, how are you executing that trade? Now, basically what this is about is entries, stops, and targets, right? And the reason you want to get into the habit of saying it in that order as well, because you want to set your entry and then you want to protect yourself. Remember, risk is first, and then set your target. So you place the orders in that entry. Entries, stops, targets. Now, execution. So it's if, then, right? So all of this is if, then, but when it comes to execution, you're saying, right, if we get the signal candle that I need, or the signaled entry, or the double top entry, or the double bottom entry, or whatever it might be, right? If we get that set up, then you go into your position size, right? So it's I risk my stop loss, I enter, and then this could be next bar market, which means you enter live at market, or you enter on a stop order. And a stop order means you're basically telling the broker that if we continue up to a price that is higher than what we're currently trading, I want you to buy more, okay, if you're buying. Or a sell stop would be the other way. So if we push down to a price lower than we're currently trading, I want you to sell this position. We're not going to be talking about shorting the market in this particular video, but that's what we're talking about, right? So a stop order or a next bar order. You probably won't have a limit order if you're looking for price action patterns, unless unless you just want some kind of set and forget. But we're talking about these two really in this particular example. My stop loss, right? And that's where you have your stop loss rules, right? So risk 1% of my account, right? You do stop loss is X pounds or dollars, right? And then stop loss is how many pips, right? X pips. Okay, and then you do the formula, and that's where your stop loss goes. That's the position size in. Okay, we're going to talk about orders in a moment, but that's kind of the execution that should be going through your head. And then the target equals 2 times stop loss. I'll just keep it simple, but these are the rules that you're going to have in place when you're building this trade plan. That's what this is. This is a big trade plan that you're building out here, right? Okay, and then is there anything else on execution? You just want to make sure that it gets filled. Remember, when you give an instruction to your broker to get you in at a certain point, it doesn't guarantee that you will be entered at that point. That is an instruction to your broker. They will fill you at the next available time, okay? People who blame their brokers because they feel like they didn't get filled or they got stopped out too early, that is just a lack of education on how brokers work, really. Okay, so don't blame the broker for that kind of thing. That's just how they work. So the orders, you go into your trading platform and you'll set a at market order, okay, or you'll set a stop order, right, buy or sell, okay, and then you'll set your stop loss order, which will also be a stop order, okay. We don't want market orders for stop loss, right? It could be a limit order, but we're not talking about limit orders in this particular video. So it will be a stop order. It won't be a at market order. And the reason it won't be an at market order is because you want to have a stop loss in place. You don't want to be watching price and then have to at market to stop yourself out. That's crazy way of trading, if you ask me. No professional traders do that. So you shouldn't do that either, right? And then the only other thing to notice on orders is you're going to see something that is called good till close or good to cancel, or you'll see end of day, okay, EOD, or sometimes they've got different references. But the difference between those two orders are, one will go on until you close it out or it hits target, and one will switch off at the end of the daily session. And that's not really what you want most of the time. So you just make sure that you've got that set correctly to suit your trading style. And then the execution, right? Basically, the execution is you just stay away, right? The execution, you've executed the trade, you've got into the trade, the hard work's done. Now it's just going to be about logging that trade, right? So logging trade in the journal. And we're going to be talking about journals in a bit more detail later on, okay? And then other than that, execution's done. That's really it, you know. It just comes down to trade management after that. And the trade management is going to be things like how you manage the trade if you're trailing stops, right? So trailing stops. When do you have a graceful exit technique, right? Graceful exit. And what a graceful exit is where you were kind of wrong. So the market goes against you, but doesn't stop you out. And then it comes back down to where you entered and you just close it out because, you know, you was wrong about the direction of the trade. So you can close it out and you have a rule that you can do that. It has to be a rule, because if you don't do the same thing on every trade, you don't know the outcome. You're then in random, the world of random, which doesn't go well with traders, okay? Trade management, you might trail stops, you might have a graceful exit, you might monitor if you're in a trade already and then there's high impact news, you might just, roll your stop to break even, or you want to have a way of monitoring that trade whilst that news is playing out, in my opinion. Trade management, you might use lower time frame to manage the trade. So you might trail stops on a lower time frame. If you trade on the 4 hour, you might use the 60 or the 15 to trail your stops or manage your position. And then of course, once the trade has been filled, you've been stopped out, you've hit target, then it's logging the results in your trading journal. This is the process that you need to follow. Once you've logged the results in your trading journal, you now have a solid set of back-tested rules of the live markets over a period of time that you can now use to optimize your strategy. If you're going to do a 6-month review or an annual review, that's the information you're going to need. All of this, if you've done all of this, you're going to have enough consistent data and a consistent approach and a consistent execution to become better as a trader instead of going back to square one every couple of years, which is what I see hundreds of traders doing, and it's just complete waste of time. So in the next video, we're going to be talking about advanced stuff. We're going to be going through front running, positive and negative carry, the money management stuff. This is all stuff that is the secret world of trading where the real money's made. So it's going to be important to learn that stuff. We're going to be talking about a multi-time frame analysis, building a portfolio, account funding and scaling, which I know is very popular with you guys, and then capital partitioning. So if you like this video, please give it a like and let me know in the comments what you'd love to see more of on this channel. What type of content has really resonated with you and given you the most value. I want to make sure we're producing more of that. And until next time, have a great rest of your day and I'll catch you then. Oh, and don't forget you can download this exact workbook for your reference in the description. So go and get that now and I'll see you in the next one.